When a stock hits a fresh multi-month high with flashing buy signals across the board, is it a screaming opportunity or, a carefully disguised value trap just waiting to catch retail investors off guard?
I mean, that is the multi-billion-dollar question in cyclical markets. The green on your screen is just intoxicating and the momentum pulls you in. But the underlying mechanics of commodity cycles are, well, they're infamous for setting brutal traps right at the absolute peak.
Let's find out which one we are dealing with today. Welcome to the deep dive. We are tearing into the April 14th, 2026 data on mining behemoth Vale SA, ticker symbol VALE.
Right.
We're going to dissect the numbers, the charts, and this sudden wave of insider buying to figure out what is really going on behind the curtain. Before we start breaking down the data, please hit that like button, subscribe to our YouTube channel, and leave a comment below. Your feedback is highly encouraged and honestly compulsory if you want a seat at the debate table with us today.
Definitely leave a comment.
And also a quick reminder, this deep dive is strictly for educational purposes. We are just analyzing data here, not giving financial advice.
So let's look at the board. As of our April 14 data, VLE is sitting at $17.64. And what stands out immediately is the relative strength. It has completely outperformed the broader S&P 500 and its own sector peers.
Wait, by how much?
It put up a 10.5% gain in just the last 30 days.
Wow. 10.5% in a month for a massive, heavy industry mining company is, that's serious movement. That is not a nimble tech startup.
Exactly. It's moving fast.
But before we try to read the tea leaves of the stock chart or project where it's going next, we have to look under the hood. We need to verify if this recent rally is justified by actual dollars coming in the door or if it's just sentiment-driven smoke and mirrors.
Yeah, you always have to start with the cash-generating engine. If the financial foundation is crumbling, short-term stock momentum is just a mirage.
Let's map out the 52-week history just to get our bearings. This has been a massive swing. If we rewind to exactly a year ago, April 16th, 2025, Vale was scraping the bottom at $8.93.
Right.
Fast forward to February 12, 2026, and it had rocketed to a high of $17.72. The stock essentially doubled in under a year.
Which forces us to look very closely at their most recent full earnings report from Q4 2025. This is where the narrative on paper kind of contradicts the reality of the business.
That's so.
Well, they reported top-line revenue of $11.06 billion. That beat Wall Street's estimates by over 2%. So they sold more material than analysts expected.
But they posted a net loss on the books, like a massive net loss. Let's unpack this mechanism because I know this trips up a lot of people. They posted that net loss because of a $3.8 billion nickel asset impairment.
Yep.
Isn't that essentially like taking a massive depreciation hit on the Kelley Blue Book value of your car? The theoretical resale value of your vehicle dropped on paper, but your actual take-home paycheck from your job is still going up. You didn't lose cash out of your wallet.
That's a great way to put it. You didn't lose a single dollar of actual cash. An impairment charge is just an accounting rule.
Yeah.
They had to look at their nickel mines and write down the estimated future value of those assets based on, long-term price forecasts.
So it's totally theoretical.
Right. Vale didn't write a $3.8 billion check to anyone. It's an accounting adjustment. To see the real pulse of the business, you have to strip that paper loss out and just look at the cash.
Right, which brings us to the pro forma EBITDA SO, earnings before interest, taxes, depreciation, and amortization. If we filter out that non-cash paper hit, Vale's pro forma EBITDA actually rose 17% year over year, hitting $4.8 billion.
Exactly. A 17% growth in operational profitability paints a radically different picture than a net loss. Furthermore, when you audit their balance sheet, the liquidity is incredibly strong. Their free cash flow yield stands at 4.28% as of April 2026.
Let's contextualize that for you guys listening. A free cash flow yield of over 4% means that for every $100 of stock value, the company is generating over $4 in pure, unencumbered cash after paying for all its operations and maintenance.
And they are returning a massive portion of that cash directly to shareholders. They announced a $2.8 billion dividend for 2026.
That's huge.
Yeah, a board of directors does not authorize a $3 billion cash payout if the core business is struggling to keep the lights on. The cash flow is demonstrably real.
Okay, so the foundation is solid. But strong financials don't force a stock price to go up if the broader market sentiment is moving the other way. You could have the best balance sheet in the world, but if the market has decided to sell, You are going down with the ship.
Oh, totally.
So how are traders actually reacting to this cash flow in real time?
Well, the real-time order flow and technical indicators are screaming bullish right now. The current price of 1764 is trading comfortably above both major trend lines. It's above the 50-day moving average of 1646 and well above the 200-day moving average of 1549.
For anyone tracking the charts, those moving averages act like the tide. When you are above both the short-term and long-term averages, the tide is just pulling you upward.
Yeah, and the momentum indicators back that up. The MACD, the moving average, convergence, divergence, is sitting at 0.200.
Which means what exactly?
Without getting bogged down in the math, that indicator measures the speed and direction of a trend. A reading of 0.2 tells technical analysts that the upward momentum is accelerating, not slowing down. The market has established a solid floor of support beneath the price at 1469 and 1383.
And the resistance.
The immediate ceilings it's trying to punch through are 1746 and 1832.
Wait, I'm looking at the RSI right now, the Relative Strength Index. The 14-day RSI is currently sitting at 69.22. Here's where it gets really interesting and where I kind of have to push back a bit.
Okay, go ahead.
An RSI of 70 is traditionally the speed limit. It's the threshold where technicals tell us a stock is overbought and due for a pullback. We are a hair away from 70. Why shouldn't a retail investor take that as a massive warning sign that the buyers are exhausted and a correction is imminent?
That's a fair point. An RSI brushing up against 70 means the rally has been aggressive, but it doesn't automatically trigger a crash. To figure out if buyers are actually exhausted, you have to look at the composition of the people buying the stock.
Right.
It's not just a bunch of day traders chasing a chart.
Okay, so who is providing the fuel for this rally then?
Look at the opposing side first. The short sellers, the funds betting millions that the stock will drop, are aggressively retreating. The short sale ratio dropped heavily to 25.37% by early April. The bearers are closing their positions.
They're giving up.
Exactly. But the most critical signal is coming from inside the house. Corporate insiders are buying real stock with their own personal money right now.
You mean the executives?
Yeah, specifically, Graziel Parenti went into the open market and bought 10,464 shares. Vice President Sami Arap-Sabrino bought 12,990 shares.
Wait, really?
Yeah. Both of them purchased at roughly $16.11 a share earlier in April.
Let's pause on that because the magnitude of that signal really cannot be overstated. There's an old rule on Wall Street. Executives might sell their company stock for a dozen different reasons, right? They might be buying a house, diversifying their portfolio, or paying a massive tax bill.
Right, sure.
But they only ever reach into their own pockets to buy open market shares for one reason. They believe the price is too low, and they want to profit when it corrects upward.
It is the ultimate vote of confidence, and they aren't the only ones who think it's undervalued. Wall Street's biggest institutions are providing major tailwinds right now. Well, in just the first 2 weeks of April, Bank of America upgraded them with a $19 price target. Morgan Stanley boosted their target to $19.50. JPMorgan raised theirs to $18.50.
Okay, so it's a consensus.
Yeah, you have a convergence of insider conviction and institutional capital pushing the stock against that $18 resistance ceiling.
So to recap the bull side here, we have billions in free cash flow, vice presidents dropping hundreds of thousands of their own dollars into the stock, short sellers running for the hills, and massive bank upgrades. It sounds like an absolute slam dunk.
It does sound like one.
But institutional capital and executives have been spectacularly wrong before. Let's flip the coin and look at the dark side. Why are some analysts warning that this entire setup might be a dangerous value trap for the everyday investor?
The value trap argument is rooted in how you measure the company against its own history. If you look at the broad sector metrics, Vale looks like a bargain. Its enterprise value to EBITDA ratio is around 5x.
Let's translate that metric real quick. If you were to buy the entire company today and pay off all its outstanding debt, that's the enterprise value, you would only take 5 years of its current cash earnings to completely pay yourself back.
Exactly. And the rest of the mining sector averages about 6x. So compared to its rivals, it's cheap. But you have to look at its forward price-to-earnings ratio, which currently sits at 7.16x.
A PE of 7 sounds like laughably low if you're used to looking at tech stocks trading at 40 times earnings.
It does, but you can't compare a mine to a software company. You have to compare Vale to Vale. Its 5-year average forward PE is only 5.46x.
Oh, wow.
Right, so at 7.16x, it is actually trading at a significant premium to its own historical baseline. The market is charging you more for $1 of Vale's earnings today than it has on average over the last 5 years.
So it's cheaper than the competition, but more expensive than its own track record. That explains the hesitation.
Yeah.
But what is the fundamental bear case? What is the anchor that bears believe will eventually drag this ship down?
The bear case rests on 3 massive pillars of downside risk. First, and arguably the most terrifying for investors, China. Vale has a monumental existential dependency on Chinese iron ore demand and steel production.
Which is struggling right now.
Exactly. If the Chinese real estate market continues its prolonged slump, or if Beijing taps the brakes on infrastructure spending, the demand for Vale's core products simply evaporates.
Right. If China isn't building skyscrapers and high-speed rail, they aren't importing Brazilian iron ore.
That's the first pillar. The second is profitability pressure. We noted their cash flow is strong right now, but their net margin is sitting at a very tight 6.12%.
That's pretty thin.
Very thin. The cost of extracting and shipping millions of tons of rock is incredibly high. And if the global spot price of iron ore dips even slightly, that thin 6% margin can turn negative very quickly.
And what is the third pillar, keeping institutional money on the sidelines?
Brazil. Vale operates under the constant shadow of deep, ongoing environmental liabilities in its home country. These are incredibly complex, multi-year legal and environmental challenges stemming from past dam disasters.
Right, those were devastating.
Yeah, it is an unquantifiable black cloud over their balance sheet that terrifies risk-averse institutional funds.
So let's tie this back to the listener. We started this deep dive asking if this was a value trap. Walk us through the psychology here. Why do everyday retail investors, specifically, get caught in the trap with cyclical commodity stocks like this?
It is a brilliant psychological illusion. Imagine you are a retail investor looking at a stock screener on your brokerage app. You filter for dividends. Currently, Vale is offering a sector-leading dividend yield of about 8.01%.
8%. I mean, you see that. You think you can just buy the stock, sit back, and let the checks roll in. It feels like a massive, safe return.
But that 8% yield is a siren song. In commodity markets, the yield often looks the highest right before the collapse.
Really? Why is that?
Because the dividend is based on trailing earnings, the cash they made during the very peak of the recent commodity boom. Retail investors buy in because the yield looks amazing and the recent headlines are entirely positive. But they are unknowingly buying at the exact top of the macroeconomic cycle.
Ah, I see the trap. They buy the peak, lock in what they think is an 8% yield, and then the macroeconomic environment shifts. China slows down.
And the music stops. Demand plummets, the spot price of iron ore drops, the company's margins are squeezed, and their earnings collapse. Management is forced to slash that massive dividend just to protect the balance sheet, and the stock price craters.
Wow.
The retail investor who bought in for an 8% yield ends up losing 30 or 40% of their initial investment.
That is brutal. So if China risk, razor-thin margins, and this looming cyclical trap are the anchors trying to sink the stock, what is the counter-narrative? What is the catalyst that the insiders and the analysts believe will act as a rocket ship to blast past those $19 targets?
The short-term catalyst is operational execution. Despite the macro risks, Vale is performing exceptionally well on the ground right now. They're hitting the very top end of their iron ore production guidance, targeting between 340 and 360 million metric tons for 2026.
That's a lot of rock.
A lot of rock. And if they hit that 360 target, it floods the balance sheet with enough cash to stabilize the dividend and defend the stock price, even if spot prices fluctuate.
That is the legacy business protecting the downside.
Yeah.
But looking through the source material, there is a much bigger story brewing here. The ultimate long-term bull case doesn't actually rely on iron ore at all, does it?
It doesn't. And this is the pivot that changes everything. Vale is executing a massive strategic transformation to position itself for the global energy transition. They are using their iron ore cash cow to fund a pivot into base metals, specifically focusing on copper and nickel.
Copper and nickel, the absolute foundational metals for electric vehicle batteries, solar grids, wind turbines, pretty much everything the world needs to physically build a decarbonized economy.
And they are putting serious capital behind it. They're deploying $1.6 billion in capital expenditure specifically for base metals in 2026 alone.
Wow.
Yeah, their long-term target is to reach 700 kilotons of copper capacity by the year 2035. They aren't just trying to be a mining company, they're trying to become the indispensable backbone of the green revolution.
Okay, let's connect some dots here because there is a massive geopolitical variable hiding in their 2026 data. Indonesia.
Right.
Indonesia controls the global nickel market, and they are planning a 34% cut in their nickel production quotas for this year. If a third of the Indonesian supply suddenly vanishes from the global market, doesn't that inherently change Vale's valuation overnight?
The mechanism of that supply shock is incredible to watch. Indonesia has heavily dominated global nickel supply for years. If they deliberately restrict their own production quotas by 34%, you have an immediate violent supply shock hitting the global market.
While EV demand keeps going up.
Exactly. At the exact same time, global demand from EV battery manufacturers is unrelenting.
Supply drops off a cliff, demand keeps rising, and prices skyrocket. Which means Vale's existing nickel operations outside of Indonesia suddenly become vastly more profitable.
The economics flip overnight. And remember that $3.8 billion paper impairment charge they took on their nickel assets.
The Kelly Blue Book depreciation we talked about. If global nickel prices surge because of Indonesia, the future value of Vale's nickel assets surges right along with it. That paper loss could look incredibly conservative in hindsight.
It completely shifts the valuation model. In the immediate short term, over the next few weeks, the market is entirely focused on the technicals. The stock is going to test that heavy resistance level of $18 as we approach their Q1 earnings report, which drops on April 23rd.
Every institutional algorithm and retail trader will be watching that April 23rd earnings call to see if the cash flow momentum holds up against the resistance.
For sure. But the real value proposition, the reason you might hold this stock for the next 5 to 10 years, is entirely dependent on this geopolitical pivot toward battery metals.
Can they actually do it?
That's the thing. Can management successfully milk their traditional iron ore business to fund this $1.6 billion transition into the copper and nickel powerhouse of 2035? That is the billion-dollar question.
So let's distill this entire complex web for you. Right now, as of mid-April 2026, Vale is sitting at 1764. It is being heavily supported by corporate insiders putting their own money on the line, an incredibly robust free cash flow yield, and the massive upside potential of copper and nickel in a supply-constrained world.
But it is simultaneously fighting a brutal tug-of-war against its own historical valuation premiums, dangerously thin net margins, the unquantifiable risk of Brazilian environmental liabilities, and the ever-present threat of a Chinese macroeconomic slowdown.
It is the ultimate showdown between the old economy of steel and skyscrapers and the new economy of electric vehicles and energy grids, which brings us to the end of our analysis today.
We want to leave you with a final thought to mull over as you analyze your own portfolios and look at the broader market. If Vale successfully pulls off this pivot, if it manages to transform from a legacy iron ore giant into the irreplaceable copper and nickel engine of the 2035 green energy transition, are we completely mispricing the entire mining sector today?
Are we looking at a tech-level revolution disguised in hard hats and heavy machinery? Thank you so much for joining us on this deep dive. As a final reminder, this was an educational debate, not financial advice. We want you to drop your answer to that cliffhanger question right down in the YouTube comments. Is the market fundamentally mispricing the green energy transition? Let us know. We'll see you on the next deep dive.